Welcome to Momentum Monday. Today is March 8, 2020. Happy Independence Day. Not Independence Day, Happy Women's Day.
Women's Day? Because we get an extra hour? Why is it Women's Day?
March 8 is International Women's Day. And have you bought enough toilet paper, Howard?
I have so much toilet paper. My problem is my bowels are all fucked up. I wish I could poop regularly.
Oh, you're
so I passed a stone and I saved it for you.
That's hilarious. Congratulations.
It's so painful. Have you had a stone? Do Bulgarians get stones?
Hopefully I don't get one, but I read that it's really painful, yeah.
Yeah. You were laughing when you heard I had it.
No, I didn't. Why would I do that?
Because I know you. All the people that I have little arguments with, they snicker when I'm in pain. Okay. Speaking of pain, walk me through what you're seeing.
We are in the midst of a market correction. Last week, we talked about the typical stages, of a typical market correction, how we have a quick sell-off, and then there is about 50% retracement of that sell-off. This is exactly what we saw last week in the S&P and the Nasdaq 100. There was exactly a 50% rally. And then since then, in stage 3 of a typical correction, we tend to see a lot of volatility, a lot of choppiness, a lot of gaps all over the place, and a lot of reversals. So in a typical correction at this point, the indices test their momentum lows, which in this case were last Fridays. And then if we see some positive momentum divergences during that test, which means that fewer stocks test their lows compared to last Friday, this is typically a kind of bottoming behavior. The problem with that thesis here that this might not be a typical correction. This might be something a little bit different and deeper.
Yeah, I mean, that's always the case when people are panicking. It's always, in hindsight, it'll be easy, what we should have done. Obviously what's different about this time is, the virus is different this time, and the valuations and the fact that central banks are all at zero already. Like, I'm going through all the list of what they can do to support equities, right? They can cut rates. Well, they did the 50 basis point emergency cut, which they've only done a few times before. The assets could already be in a bear market. They're not. So this could just be the beginning. But like you said, there could be some unbelievable trading opportunities, even if we're a quarter of the way to the lows. The virus is hurting regular local businesses, because of travel. Travel is the one freedom that I think people aren't used to having taken away from them. It's been such a deflationary what I worry about travel is the only thing I worry about, because it's so global. It's been in such a deflationary mode, and everybody who's doing it, and for everybody not to have that luxury, which it's a luxury. You get bored of owning just Netflix stock. And you can see Netflix, Zoom, those are the stocks that have kind of held up the best.
Yeah, anything related to the coronavirus is kind of,
anything where you're staying at home and you get your entertainment and your productivity, that makes kind of sense. But that's not exciting for investors. We need a good market. And obviously, those Zoom and Netflix, Teladoc Health has just been another incredible run. So I missed this completely. So it's just makes total sense. Doctors on demand. It's Zoom for doctors, basically. And so it's on my, burning money like it's going out of style, but has to be on everybody's watch list now in a world where you think about video conferencing as just a must-have service. And it wasn't like that stock was unknown, obviously. I mean, it's been in a bull market for...
It's been on a crazy bull run for a while.
Yeah, so it came public, went straight down. So obviously a venture-backed company. How many billion? It's only a $10 billion company?
Yes.
Okay. So it's still, you know, obviously not making money. So I say that in a world, only in today's world can I say, oh, it's just a $10 billion company. But, and I think that's the issue, is these companies are at a global scale small, but they're valued, you know, in a low interest rate world, they're already so, you know, valued perfectly that's the risk here. That's my biggest risk, is that, you know, trading momentum is easy if the trend's working, but like once these trends break and behavior kind of checks itself, Ivan, I mean, it's much harder for me. You obviously are seeing the world differently. So coming into Friday, you're seeing like, obviously you're looking at, there's a lot of swing opportunities to the long and short side.
Not, I wouldn't call them swing, but definitely some great intraday opportunities. And I've been active last week, taking mostly intraday opportunities. I took a couple of swing trades here for that bounce early last week, but I've been mostly, I mean, we have to adjust to the changing market conditions. Obviously, in this market, directions are changing very quickly, so we need to be nimble and we need to take profits quickly, because if we don't, they disappear. So in corrective markets, we have to be very nimble. I mean, if you're not nimble, just don't even participate. And in general, when that correction ends, I don't know when it will, but when it does, it will create tremendous opportunities for long-term holders, for position buyers, because the best entry points for position traders, for longer-term buyers, is right after a sizable market correction. And the bigger the correction, the bigger the opportunities. So I think with the panic related to the virus increasing on a daily basis around the world, we might see another leg lower, another 10-20% leg lower. I'm not saying it will happen next week or it will happen in a straight line. There'll be some huge rallies along the way, but there are quite a few factors that are coming into play right now. For example, Saudi Arabia just started a price war in crude oil. Crude oil was already at record low prices. Now they want to push it even lower. They just increase.
But you see how, like, I get that. See, that one makes sense to me, because oil was telegraphing something coming. It's kind of like 9/11. If you look back to 9/11, of course, it's a tragedy, but the market was already in a mode where bad shit was going to happen. So if you look at the banks, So if you look at oil, go back to your chart there, Ivan.
Well,
this is just.
The CTF doesn't go that far, but I can pull up.
No, but I don't need to go back to 9/11, but I'm just saying with oil, you can see that this price war now makes sense. Like the oil was in some massive decline for a reason, and now we have the reason. The price war is coming. Like these countries are like basically mortgaging their future to selling as much oil as they can now, because they're like bankrupt in many ways. And so now we know, and that's more dangerous for the United States than anything, because that proves that middle America, where all the fracking and oil and oil production is, all those levered to the banks. And now we can see the real risk in this oil price war really still falls on the US, but it's more economically with all the banks that have loaned money to all these drilling,
Everything is related, yes.
Yeah, so they're all related. So if we go look at like the banks, XLF, like their crisis is probably only credit, because you can see like the banks were looking pretty good. If you look at XLF, they were looking pretty good a month ago, 2 months ago.
So everything was looking pretty good 2 weeks
ago.
Yeah,
but the banks are really going to feel this oil stuff, because they don't make money off technology companies, right? Their last bastion are these like old American companies that they've been pillaging with lending. And so I wouldn't go near the banks. And all the European banks that were like bouncing along the bottom, I don't even remember the that must be a disaster at this point.
Yeah,
There we
the
go.
testing multi-year lows. Let's
Where's
pull
Deutsche Bank? Where's Deutsche Bank?
longer term. So yeah.
Maybe where's Deutsche Bank?
1 second. Deutsche Bank. Yeah, just the usual. They've been in a
Just
downtrend.
teasing people, and these are just like, so anything weak, you just got to clean out of your portfolio like right now, right? Like I just think we're in some kind of like
Yeah.
accelerating
Energy, retail.
yeah, so energy, retail, like businesses that are burning a lot of cash. If you're not actively looking to figure out a way to really cut costs, and so yeah, I mean, there's some problems in the system, and these are like the real times that you got to look at your portfolio, be honest with yourself, and like make sure your ideas, because they're just pieces of paper in equities. You know, if you're not willing to be nimble, as you just said, you know, figure out what percent you want to be long the S&P, if it's 30% or 40%, and then, you know, every 10 or 20% down from here, you can have a game plan. But this market will be really tough for people that can't adjust their time frames because there's just going to be so much headline movement.
Risk, yes. I mean, the bull market has been so good.
That's interesting. So is that the S&P weekly, Ivan?
Yes.
So we really, yeah, I think if we went, I think like 2,400 would like kind of get, if it was speed, would get me excited. I mean, that's just wishful panic thinking. You know, take us back. That's when Trump closed the government, and that's kind of where the markets reacted to when just the U.S. government was shut down. So I think if we went back there, it wouldn't be crazy to me.
Well, at 260, so the last big correction was, you know, end of 2018.
Yeah.
And then the S&P bounced near its 50-month moving average, right at it, which was like about 230. Currently, the 50-month moving average is around 260. So yeah, I would not be surprised if.
I just wouldn't be surprised. So I'm looking personally for trading activities. You know, at 2,600, I'd be looking to buy, like, selling some premium in the 2,400 area. So that's where I think in a true panic next week, you're never going to happen the way I plan it, but you got to have a plan. And those are the, you know, Apple at 220 or 230. Which we're not going to see it, but you have to be prepared to put in your, I call them stinky bids, because they may, in a panic, you may see them for 20 minutes. And so for stinky bids, you know, 230 on Apple, on Google, I think it's, for me, it's like 1,200. Pull up Google for a second.
Why are you saying we're not going to see it? Just a little over a year ago, Apple was at
I'm just saying, like, but I'm saying I don't expect to see it because Apple held its lows of even last week. So let's, let me pull up Google for a sec. For me, a stinky bid would be right around 1,200. You know, which you're right. You could see that on a week opening. So again, like this correction has been so fast. Whereas some companies are never going to recover. I look at Disney, and it was one of my 8 to 80 companies, and I can't wait for a rally. I mean, I'm like a seller of this stock. It's over. You know, I don't care what they're pitching me. The stock is a goner. It'll take a decade for it to recoup all the damage that it just caught up with them. The stock price of Netflix says that, you know, you're not going to put a dent in there. And Disney had their moment, and it's over. So there's certain companies that are just going to struggle to regain their all-time highs, in my opinion. And so you've got to go find the new breed. So Teladoc, Zoom, you know, some of these enterprise stocks that continue the productivity, remote work. I think for true leverage bounces, Ivan, you go look at the transportation. I'll end it with looking at transportation. I mean, we really need to hold here. If you look at, we're back at the 2018 lows.
These are the airlines. Warren Buffett basically owns about 10% of all major U.S. airlines, and I'm sure he's buying right now.
Well, if I was going to gamble and lever even though I hate airlines, and that's exactly with him having, I don't know, 30% of his money in cash, and he already owns all the railroads. I think if he had a chance to take over the skies at really cheap prices, I think he's going to have stinky bids all over here. I think banking, who cares at this point? I think airlines would be more, transportation would be his play. So normally I would not do airlines, but because they can go to zero because of the leverage. But I tell you what, like Alaska and Southwest, I was looking at Alaska. Oh my goodness, ALK.
Well, all of them. I mean, also the cruise ships, RCL.
Yeah, Carnival. So again, I think some of those is where Buffett's going to be fishing around. You know, logistics and transportation. I think because of the energy problems, the banks are just no way for me. I don't trust the banks. And then technology, stick with stuff that you know people are using, whether they're locked in their houses or not. And then the S&P for me, 2,600 is where I get excited. Where are you? You're net long coming into the Monday, Ivan?
I'm 100% cash.
Oh, you're 100% cash. Okay.
Going into Monday, I do have a small position in TMV, which is basically a kind of a short play on the long bond. It's a really small position, like it's kind of irrelevant. Just put it on.
You bought it or you're short it?
No, I bought it. I bought TMV, which is basically a short.
Yes, you're expecting rates to bounce here.
So I closed half of it already. Just took profits, and we'll see what happens with the other half. But I remain really nimble in this market, and every week I send a free email, and in this weekend free email, I basically outlined all the trades I took last week, and you will see there are so many trades in leverage ETFs, in the TQQ, SP, in the TDA. So right now, since the correlations are so high, I mostly trade those ETFs, and I have a list of about 20 virus related plays, and they continue to trade well, so I nibble on those two just for a quick trade. So this is what I'm doing.
I just don't have the time. I'm thinking major levels. What would I do? Full disclosure, Charlie at Compound manages my capital, and I'm I was 40-60 stocks, bonds, going into this correction, and at one point this week I said go to 50-50, so I added 10%. I think at 2,600 I'd be probably 60-40 stocks, bonds, and so I'm just moving tiny bits at major levels at this point. But all signs of a panic are right, and some kind of significant lift would happen right now. And Friday afternoon might have been the beginning of that. The wild card here is emotions. But in terms of readings with the VIX over 50, with the headlines, we already know America's behind on this. We've seen the Chinese come through the other side of it. The Chinese stocks did not completely collapse, and they've gone through their 60 days. If we look at Alibaba, it kind of held 200, I think.
Yeah. I mean, if the U.S. market has another leg lower, I mean, don't be disillusioned. The Chinese stock are going to follow.
Oh, no doubt. But I'm saying but my point is China seems to have gone through their 60 days of hell. And so if you're gonna factor that in at all, you just can't factor in how much people will panic. So that's why I'm thinking of levels. But at the same point, it's quite possible that we've seen the lows. It's just very hard when we're in this much of a high of a VIX and this much volatility to guess. And so I think people just need to be careful, because like we see with Disney, like we see with a lot of stocks that were kind of hanging on and then tipped over, like the financials, like the energy stocks, it can get really ugly fast. and stocks can begin long downtrends, and this would be your major warning. Like this last week would be your first warning, but in 6 months you may look back and go, shit, that was a good warning. Even though it was a 20% hit, that was the best 20% hit I took.
Yeah.
So that's what you got to remember. And then small caps, Ivan, just looked like shit.
Yeah, they already went below their momentum loss from last Friday, but this is typical. This is why when it comes to correction, just pay attention to the S&P and the Nasdaq 100. These are the levels you need to watch.
Because that's where the money is going to go first. Bonds, and same thing with bonds. Money is still, believing. If we look at the bonds, Ivan, it's just, I think I'm starting to myself be finally convinced that like rates are going to zero. Like, even Trump may be right. It's like, you know what? It's like Europe's live with it. It's not going to change anything. We might as well take them to zero ourselves. And, we may live in a world where, all you expect from banks is to pay them to return your money one day. So, negative interest rates literally may be in our future sooner than we think. So all those robo-advisors paying you 2%, I think those are bad businesses. Like, if there was a bad business, I always thought it was these, robo-advisors. Now those businesses lost 20% of their assets. Their customers can flip to Vanguard in 1 second, and they've been promising 2% interest on your $1,200. Be careful, you get what you pay for there. I think there's a lot of these financial businesses that just don't have the margins to get off the ground. All right, Ivan, have a good rest of the week.
All right, you too, Howard.
All right, have a good trading week, everybody. And thanks, Marcus Smith, for the charts. And Ivan, I'll see you next Sunday.
Okay, all right.